In a previous video, we discussed Canada's progressive tiered tax system. As you can imagine, paying 30, 40, or even 50% of a dollar earned can have a serious negative impact on the long-term growth of your portfolio. In this mini lesson, we're going to illustrate the power of tax-sheltered growth, which can be achieved through various plans, such as the Registered Retirement Savings Plan. Before proceeding, I want to remind you that here at SeeWhy, we often exaggerate to make a concept easier to see. This is our rationale for using a high, but also realistic marginal tax rate of 50%, which will magnify the impact of tax sheltering. That being said, tax-sheltered growth benefits all investors, even those in lower tax brackets. Let's take a look at an example of tax-sheltered growth versus non-tax-sheltered growth. Siblings Jack and Diane each have $100,000 invested in a bond portfolio that is expected to generate a 5% return. Jack holds his investment within an RRSP, which is a tax-sheltered plan. Diane holds her investments in a regular brokerage account, which is not tax-sheltered. Assuming a 50% marginal tax rate, let's see how each of them make out with their investments. Let's first take a look at Jack's investment, which again is held within a tax-sheltered plan. At the beginning of year one, Jack has $100,000 invested, earning 5%. In the first year, he would earn $5,000 interest income, calculated as follows. $100,000 times 5% equals $5,000. Since the investment is held within a tax-sheltered plan, there would be no immediate tax consequences. In other words, the full $5,000 earned could be reinvested in year two. Assuming the same investment return, he would now have a total of $105,000 invested and therefore would earn interest income as follows. $105,000 times 5% equals $5,250. Let's calculate how much his investment would be worth at the end of year two. $100,000 initial investment plus $5,000 earned in year one, which was tax sheltered, plus $5,250 earned in year two, which was also tax sheltered, for a total of $110,250. Notice the interest in year two is a little more than in year one because he is earning interest on the interest that he received in year one. This is referred to as compounded growth. Now let's look at Diane's investment, which is held in a non-tax sheltered plan. At the beginning of year one, she also has $100,000 invested with an expected 5% return. In the first year, she too would earn $5,000 in interest, calculated as follows. $100,000 times 5% equals $5,000. However, that income would be subject to tax. Since she's in a 50% tax bracket, half would go to taxes and she would only get to keep $2,500. In year two, she would have $102,500 invested compared to Jack's $105,000, resulting in only $5,125 in investment income being earned. Once again, that income would be subject to tax. Half would go to taxes and she would only get to keep $2,562.50. Let's calculate how much her investment will be worth at the end of year two. $100,000 initial investment plus $2,500 after-tax income earned in year one plus $2,562.50 after-tax income earned in year two for a total of $105,062.50. To recap, Jack holds his investment within a tax-sheltered plan, and at the end of year two, he would have $110,250, which is considerably more than Diane's investment value of $105,062.50. The difference would be even more significant over many years. For example, if this continued for 20 years, Diane would have approximately $163,862, whereas Jack would have approximately $265,330. As you can see, tax-sheltered growth can be a huge benefit. Lastly, I should point out that tax-sheltered is not the same as tax-free. Jack holds his investments within an RRSP, so when he eventually withdraws the money, there would be tax consequences at that point in time. In retirement, though, he may be in a lower tax bracket given he has stopped working. For more information on registered retirement savings plans, check out the mini lesson called RSPs in 3 Key Points.